Praj Industries. Why you should pick up this stock and when? India's largest ethanol equipment manufacturer, Praj Industries, continues to deliver strong growth and the business has seen a significant uptick with higher orders in hand, improving margins and strong cash. Government's decision to fast-track the ethanol blending has also boosted the company's order books. Apart from ethanol, Praj is also a supplier for critical process equipment, brewery and water as well as wastewater treatment. Currently, the stock is trading 31 times its fiscal 2022 estimated earnings, which is high. Praj's market presence. Around 70% of the revenue comes from the domestic market and Praj Industries has a strong pipeline of projects. Currently, the ethanol blending is at around 6% as against 2 to 3% about 3 years back. To further help its cause, the government has speeded up the blending to achieve 20% blending by the end of 2025. This means a huge amount of investment in the distillery capacity. This was earlier planned to be achieved by 2030, but the government is now pushing for earlier deadlines. Even 20% blending would require huge investments in the brownfield and greenfield distillery capacities, which could be anywhere in the range of 10,000 to 15,000 crore rupees. Praj Industries, being the leader in this segment with cutting-edge technology and experience, is going to be a key beneficiary of this growth, which is already showing up in its order inflows. Now let's talk about financial performance. In the current fiscal, the revenue is pegged at just a few crores more than last year's earnings. EBITDA margin is also projected to remain the same, while net profit would see a drop of around 8%. During the December quarter, the company bagged orders worth 605 crore rupees, which was highest in the recent quarters, taking its overall order book to 1,665 crore rupees, which is 1.7 times its annual revenue, providing strong revenue visibility considering their short cycle projects. But despite bagging 200 crore rupees order from IOCL for the water and wastewater treatment, the engineering segment reported a 49% year-on-year decline in revenue as against a 55% growth in the case of bioenergy business during the last year. Future outlook. Fiscal 2022 could see strong growth in revenues along with expansion in margins because of the higher capacity utilization, changing revenue mix, and high-value projects. Engineering business is expected to start witnessing growth in the coming quarters led by orders in hand. Net profit has been estimated to increase to 101 crore rupees in FY22 from 60 crore rupees in the current financial year, with EBITDA margin touching 9%. But while the trajectory has changed for the better, but as I've seen in the past, the business lacks predictability and there are times of growth disruption that puts higher valuation at risk. So our advice for investors: accumulate gradually on every decline.